So the table that was set out by Merton 1977 provided a framework or reported results of his formulation for estimating the guarantees associated with when loans are made and deposit insurance. At a more basic level, the loan guarantee is equivalent to a put option on the value of a firm's, if we thought of a bank, the liabilities of that bank, and then relative to the value of the assets. So if the assets fall below the value of the debt, then the deposits cannot be made good. So to estimate protection written on those deposits is equivalent to looking at estimating the value of a put option. In other words, when a bank's balance sheet could be considered as being made up of on the asset side as just loans that are made by the bank, but and those loans could be risk-free, or thought of as being risk-free. But then there's also the bank must assume responsibility that in the event that borrowers cannot make good their loans, that they can recover some assets from the defaulting companies they have lent money to. So the position of a financial institution that lends in terms of its assets, in a very simplified way, we could consider these assets as being risk-free, but then also there is a guarantee which is equivalent to a short put on those same assets. So in setting out this framework, Merton made available this table 1, and we're trying to replicate using, at least initially here, a simplified structure where we initially start with just setting out using Black-Scholes parameter inputs. If we know S, K, R, sigma, Q, T, estimate the value of the put using a Black-Scholes put framework set out here in VBA. And then once we've estimated the value of that put using those parameter inputs, estimate the value of the guarantee. So if you like, the put here is equivalent to GT, and then the value expressed in terms of cost of deposit insurance per dollar. So cost of deposit insurance per dollar of insured deposits would be equivalent to GT. So the put, I8, divided by the value of the exercise. Remember this K here, the exercise K is equivalent to B. And so we discount B at E negative R by T, and that then gets divided into the value of the put. And so if we track down through, we can see the values I've obtained here are equivalent to the values observed here in table 1. Also important here is the tau value that's given here in the Merton table 1, Merton 1977 table 1. That tau of 0.006 is equivalent to a Black-Scholes sigma of tau, so 0.06 divided by t, t is 1, and then take the square root. And the square root taking the square root is equivalent to going to the power of a half. Okay, so we convert the tau back into a sigma, and we also assume here that consistent with the framework here, that the time horizon is 1 year. Okay, so if we move down the table a little bit and come down here where we have deposits to assets of 1, in other words, no equity buffer, and the volatility, the tau is equal to 0.06, that would imply a Black-Scholes volatility of 0.07, and working out the value of the put using the VBA function as already outlined, and then dividing that by the value of B, discounted risk-free rate, we get the value here of this in terms of cost of deposit insurance per dollar of insured deposits is 0.03. In other words, if you had no equity and you were insuring a loan or deposits where the value of tau is 0.006, then for every dollar lent, the cost of insuring those funds would be equivalent to 3 cents, 3.1 cent. So for $100, the cost of insuring deposits would be $3.1 or $3.89, $3.09 approximately. So these costs can be quite substantial. They're not trivial. The costs here are very, very steep at times. Of course, as the deposits to assets falls, in other words, in this instance, where we have high levels of equity, now this would imply that the equity in the balance sheet is equivalent to 15%. If deposits are the only source of funding and they represent 85% of value of the loans and we have 15% equity, then the cost of insuring those loans can be also quite small. So the deposit to asset value ratio has also a very substantial impact on the cost, the actuarial cost of deposit insurance. So here we find that for one, that it's not even 1%, it's about 1 basis point, the cost of insuring, so long as there's a substantial buffer of 15% and we have low volatility. A tau of 0.04 is equivalent to 6% Black-Scholes sigma, to a standard deviation of return on the assets of 6.32%. Again, the cost of insuring that in terms of a percentage would be very, very small. So let's have a look. It would be, 1%, so 1 basis point, in fact, right, equivalent to 1 basis point. Okay, and we'll convert back to decimal. General. Okay. Okay, so I've highlighted this example here. We'll have a look at this number again. I want to go back to the formula I set out here. So when we represent the guarantee here with this type of formulation, how do we implement this? Okay, I go back to the spreadsheet and I go to the insurance deposit guarantee, and I come to, if I can find it, yeah, this example here. So this example that I just highlighted, if we represented this in terms of work employing this formula, we could say that to estimate lowercase g using psi h2 minus 1 over d psi h1, we estimate h1 first, and that would be equal to the log of d. Now d here is equivalent to d over v, and so in this instance, when it's the deposits to assets is equal to 1, d is equal to 1 minus tau of 0.006 divided by 2 divided by the square root of tau. We get this number, which I have worked out also here for h1. For h2, it's equivalent to h1 plus the square root of tau, 0.03873, same as here. And then to implement the last part here of the formula, psi, so the normal cumulative probability of h2 minus 1 over d, 1 over 1 is 1, times normal cumulative probability of h1 being is negative 0.03873, and when that's worked through, we get a figure consistent 0.030894. So this is intended to illustrate that the formulation that we have here is really no more than the formulation of a standard Black-Scholes type formula that we're accustomed to using. If I use a Black-Scholes type framework and using this function here, right, Black-Scholes BSM put, it's clear what I'm using is the standard Black-Scholes type function. So I'm calling up an algorithm here based on classic Black-Scholes Merton model, and when I divide that through by the value of the debt discounted, I get the same figure for the cost of deposit insurance. So this figure here corresponds with this figure here, and in terms of its implementation using this framework, we recover the same figure, so 0.03089. Okay. The economic interpretation of this figure is for $1 insured, you must pay 3-cent insurance. So for $1 deposits using these parameter inputs, the costs of insurance using a Black-Scholes type framework or an actuarial type framework is 3 cents. So if a government decides to insure $1 of a bank's deposits, that's equivalent, if there's no costs imposed, that's equivalent to government subsidizing that bank to the tune of 3 cents for every dollar of deposit insured. And that can be quite, when volatility is elevated, when there's very low levels of the bank's own equity, the cost of government insuring commercial banks, their loans, their deposits, can become very substantial. And again, it's not always clear what type of guarantees government provides, but given the recent financial crisis, governments tend to guarantee not only the deposits, but the entire bank. And when we observe the behavior of the German authorities, when we look at the Bank of England and the Financial Stability Authority with regard to Northern Rock, when we look at AIG, very often governments provide a kind of blanket guarantee when push comes to shove. So the costs here are substantial.